Good evening, traders. Welcome to our risk management session today. My name is Mathew. Today, we want to look at scaling in and out of the market and how you can do position sizing. Remember, risk management is very important in your trading. Even when you have a strategy, a very effective trading strategy, it doesn't work 100% of the time. So you need to control the amount of losses just in case things go sideways. Remember, we are speculating in these markets. Most of the times, the traders find it very hard exactly at the time when you've understood how these markets works. Because of risk management, you get so ambitious, you have a target, you want to be consistent, you are giving zero chance for failure. And failure in this case means stop losses or losses. And then it becomes a disaster in maintaining how do we call it? Maintaining a sustainable level of risk. And that's what we need to look into. So one of the approaches is scaling in and out of the market and position sizing. So what is scaling in and out of the market? So scaling in is where you add positions at intervals, or maybe intervals not the right term to use, but adding positions into whatever you're trading as the price unwinds in the desired direction. This is where you hear of, if it's on an uptrend, buy the dips, for example. This is where you see if it's on a downtrend, buy the pullbacks, for instance, or the upward spikes. So that is scaling in. Let's say, for example, you have an account which can afford, like, let's say, 5 lots. Instead of entering a 5 lots position all at once, you're trying to be cautious at the same time. So you also want to see that you can ride the market with less risk. So you want to enter your trades, let's say, for example, 5 entries of 1 lots each as the price unwinds in the desired direction, or in the desired trend. So that is scaling in. So for you to scale in, then it means you have to understand the maximum lot size that your account can take in. And that's why we will later look at position sizing. Scaling out is simply the opposite of scaling in. Now you're closing your trades. You're getting out of the positions which you have entered in the market. And this means that you're closing the positions that you have in portions, for example. If you have a 0.05 or a 5 lots or whichever trade size you have in the market, then you decide to close them in portions or in parts as the trade moves in your favor. Remember, it reaches a point where the price pulls back and then it wipes out all the profits you had attained in the markets, and you want to prevent the possibilities of all that. If you've been in these markets, you know you can have a very, like, for example, what gold did on Friday. There was a very big or a sharp move to the upside, all the way to the highs of the last week 4 hour highs, sorry. And then the price pulled back again to the downside and it maintained there. So let's imagine that you had a 1 lot position to the upside, and then after some point, the price pulls back again. If you had a scaling out approach or tactic in the markets, it means that you could have protected maybe 75% or even 50% of the position before it all wiped out those gains. Okay, that's what we're speaking about. It's better applied in a trending market, especially for scaling in, better applied in a trending market because you have entries with pullbacks, either to the downside. If it's a downtrend, you're entering when the price pulls back to the upside before resuming the trend. If it's an uptrend, you're buying the dips. So better applied in trending markets, but for scaling out, you can apply scaling out better in trending markets as well, but even in a range because you're closing your position partly. So position sizing has to be part of the scaling in because you're trying to close, especially when it comes to scaling in, trying to close or to enter your trades in bits. But again, you don't want to enter so many positions, right? such that it exceeds the capacity that your the capacity of your risk which you had set in the market. So you want to set the amount of risk, for example, the amount which you're willing to use in trading, or for example, in let's say in trading in that day or in that position is, let's say, 5 lots. Then you might want to enter your trades. You fill in your trades in one lot, in sets of 1 lot, right? So that once you attain 5 lots, then you're done. You can't keep on adding. So you need to understand how many lots do you need to enter, because you also want to keep in mind the aspect of risk management. So when you're estimating your position size, you need to consider the risk amount. What percentage of your account are you risking? For example, is it 5%? You have to know what amount is it out of your whole capital. The distance from your entry. So your setup, how many pips is it giving you from the entry to your stop loss level? And then, of course, you need to understand the standard lot value. What is the value for standard lot? Yeah, pip value for the standard lot for that instrument which you're trading. That is where you are advised to at least trade with the instruments that you like for quite some time, so you understand a little bit more of the details or these aspects to make it easier for you to trade in this instrument. For example, you have so many financial instruments and you can find setups in these different instruments, but remember, sometimes it's difficult to understand the pip value if it's your first time. So if you've never traded with NASDAQ, for example, you will not know how much is the pip value for one standard lot. Okay. So these are the things that you want to know or you want to have to calculate the lot size. The formula that you can use to estimate is amount of risk, the amount which you're willing to risk, and then you divide by the stop loss distance, you multiply by the standard lot pip value. Yeah, that's how you can estimate the lot size. Or alternatively, you can use online position size calculators. You can find them in various, if you just Google position size calculators online, you can find them and you have to input different values. So let me go with, for example, what we have here, number of contracts, amount of risk. I don't know whether I can use an example of an account which I have here. I don't know whether I have a trade. I don't know whether I did the right lot size estimation, but let's look at it. Yeah, I have a $250 account. So let's try to estimate the lot size so that we know how big position size or how much of the position size do we have to spread out in our positions if you were to do multiple entries, right? Sometimes we call it layering, right? Layering, you can call it scaling in, okay, or adding onto your position. It's just the same thing. So I have an account here, it's $250. So $250, you're advised to risk 2% of your account. Let me get something to write with. Yeah. So I have a $250 account. So this $250 account, let's say, for example, I'm generous with the risk. I want to do a 4% risk, 4% risk per trade. So 4% at every single trade which I'm entering. Let's say, for example, I just have one trade at a go. So if I do 4%, which is 4 by 100, that's how you calculate. Multiply by 250. This is a very generous, that's a very high risk level. So here I'm going to have, is it 2.5? It's going to be how many dollars? $10. Yeah, a $10 risk. So if I enter a trade, maximum I'm going to take is approximately minus 10. Minus 10 loss. And this is my risk amount. That is the risk amount. So with this risk amount, let's say, for example, I'm trading gold. Gold is XAU USD. So for XAU USD, I also need to do one lot gives a pip value of what? How many dollars? So in this case, usually for gold, one lot will give you approximately, sorry, we don't, okay, one lot will give you approximately $10, right? So we will use this one in the formula. So we use this one at some point. So we have the risk amount. We know the pip value for a standard lot for gold. So the thing which is remaining is a stop loss pips. So these stop loss pips, remember your setups are going to be different every time. You cannot have you cannot say you want to have like okay, you can, yes, but mostly you find setups that are giving you a different as you find setups which are different in the market, okay, and you want to be flexible. So sometimes you get 10 lots, 15 lots, 20 lots. So let's say, for instance, for this trade, which is here, this position which you have entered here, then good enough, it's giving us some profits. We'll use it to learn scaling out. So position sizing. So with this position which we have here in 5 minutes, with the entry at this point and stop loss here, how I could have estimated, or how you could have estimated the lot size to use. I have used 0.05. I didn't estimate, but how could you have estimated? For example, if I decided to enter this position, this point here, from that level 1980 to the low of the week, or down here, let's say a little bit further to 1970. If I'm taking 15 pips, exactly 15 pips stop loss. 15 pips stop loss. So the stop loss distance is 15 pips. So I have a standard lot pip value, I have the risk amount, and then the stop loss distance from where we have this entry to the stop loss distance from the entry is 15 pips, this distance. So how could I have estimated that position size, the right one to use with the $250 account which I have? Then I'll apply the formula. It should be very easy. It should be very simple. Once you understand it, it's just a simple process to follow. So in this case, I'll have it's supposed to be the number of contracts or lots, amount of risk, which is I'm risking $10. So $10 I divide by here I have a stop loss. So stop loss distance. Sorry, I didn't write. SL distance here is SL distance. You've seen it's 15 pips. Okay, 15 pips. So this 15 pips is where we have to fit in the $10 loss. It has to fit in within that loss. If we exceed this one, then we are breaking our drawdown level for that trade. Remember, this is like setting the drawdown level for a single trade. So it is going to be $10, which is the amount of risk divided by number of stop loss pips. This is 15 pips. So 15 pips, and you multiply the 15 pips by the pip value of a standard lot of that specific instrument. In this case, our standard lot value, pip value for gold is $10. This is giving us 10 divided by 150. And this is an approximate or estimate of 10 divided by 150. If you have a calculator, you can do it. 0.06, giving us 0.066, moving all the way. It's recurring. How did we write a recurring number? Did we have something like this? I don't know. I don't remember. But if you round up, it's going to be 0.07, something like that. 0.07. That's not bad. So this 0.07 lots is what we will use for a maximum loss of $10 in a 15 pips move in gold, approximately, or maybe roughly 0.05. You might decide to use exactly that lot size, right? Or just take a smaller size. For example, if you, in the case of scaling in, you might have decided to enter in 0.01 sets. So that is how, this is the first step of estimating the maximum lot size which you can enter with the risk that you're planning to use in the market. So in this case, I can enter a maximum of, with a $250 account that we have here, I can enter a let's say 0.06 lot size, lots. I can decide to enter this trade once and set the 10 pips, the 15 pips stop loss. And that's that. You set, you forget, you let it run. But in this case, if the trade was to go against you, for example, then you would lose that $15. The other approach you would do, which we are covering today, is scaling in. Scaling in is where you decide if you are to scale in, knowing that you can enter a maximum of 0.606, sorry. If you are to scale in, then you decide if this price was trending upwards like this. I mentioned that this approach of scaling in or layering is better if you have a clear trend, if it's an uptrend or downtrend. In this case, might be better. So in scaling in, you might decide to have, this is our initial, from an entry this point, this is our, down here is maybe 15 pips. This is where we lose, if you enter at 0.06, we would lose all that. But then decide to do your 0.01 here. With the 0.01, then you have another 0.04 to enter. Then the price trends to the upside. And of course, usually with this one, you protect your trades. So you might want to use it together with a trailing stop. Okay, I didn't mention it. A trailing stop is where you pull the stop loss to move on the direction, or to follow, to move on the direction or the other side of the profits. Scaling in, simply, I can show it on the trade which is running if it has not reversed. So you have a trade here which is running, and we have some profit. So then if we are to scale in, then what I can do is take this. If I was to trail the stop, then what I would do with this position is just have the stop loss move to the other side of the trade. So I cover at least $2, for example. So $2 is covered. I know that one is in the pocket already, whatever happens. But I'm expecting this price to trend all the way up, maybe to, let's say, this level up here. Okay. And assuming I didn't enter the whole 0.05, because I did 0.05 already. So I could have entered 0.01 and then go on layering the trades or doing entries at intervals. And you can see how the price is moving up, down, up, down. Let me show you what we're talking about. Price pushes up, moves down. So we had an entry here, pushes up, maybe down this way. I could have had another 0.01, a 0.01. The price pushes up, moves the downside, pull back a little bit. This is buying dips, another 0.01. So here we have 0.03. So if the price pushes up again and pulls back a little bit, to get another entry. All that time, we are moving the stop losses to break even or on the other side of the profit, or on the side of the profit. And in this case, it's advisable that if the second trade, for example, moves to the side of the profit, then the first trade that you entered earlier also move its stop loss to that level. So with the trailing stop of the previous trade, with the price moving to, or the most recent trade turning profitable, then you also want to have all the other stop losses for the previous trades. You trail them to the same level with the latest trade. Okay. I don't know whether that's clear, but that's what you want to do, so that you have been very careful with entering your positions. You've layered them such that even if the price was to pull back, then the last 3 entries, or the last, let's say, for example, you didn't enter all the trades before the price started to reverse and it hit your trailing stop at the 4th entry or the 3rd entry, then you're much better. You don't have any losses. You have taken profits, right? So that is scaling in and its advantages. You fill in your positions at different intervals because you're being cautious of the possibility of the price pulling back and reversing. Okay, that is with the scaling in. So when it comes to scaling out, and this is what we will do now with the position which I already have. When it comes to scaling out, is where you decided to enter with the lot size which you estimated. You did a 0. In this case, did a 0.05 entry, for example, like I did. And in this case, what you're doing is, can we draw this? Is it possible to draw this? Let me see. You have entered there, the price is moving in your favor. So from this level, your trade at this point is, so you had 0.05 entry. Up to this point here, your trade is, let's say, plus 15, right, as profits. So up to this level, that's some profits already. So you decide to close part of this. Let's say, for example, 0.03. You want to do 0.03. You take the profit and then leave 0.02 running. And then 0.02, you as well want to use a trailing stop. So in this case, you already have 0.03, profits for 0.03 in pocket already, that's yours. And then 0.02, you have put a trailing stop, right? So you can as well keep on running or pull back and hit the stop loss, that's okay. So that's what we call runners, keep the trades running, right? And this one, we will do it practically with the position which we have in gold. Okay. Let me have the MT5. Remember, you can send your questions on the chat for something that you want me to clarify further. So here we have a position which we entered with this point of interest here. Although it's in the evening, we might not have it run much further. This POA give us some entry with a 15 pips stop loss, kind of running to the upside, but we don't know whether it might go further. So cut the long story short, you go to the 15 minutes, we have this trade running. Already we have moved the stop loss from the loss side to the profit side. That is what we call trailing stop. And I have the chance of moving all this stop loss all the way up to around this area of $10. I mean, that's okay. That's already like, how many pips are those from this level? And it's in the evening. It's around 20 pips. That's not bad. Although the target might be at the top here. So we want to scale out. Instead of leaving all the 0.05 running, we have $14. How about if we decide to close like 0.03 lots and leave 0.02 lots running? That is scaling out. Okay, that's scaling out. You want to reduce the position that you have in the market, because what if, okay, I don't want to close this trade because I'm expecting it can keep on running all the way up. You never know. But there's still the chance of this price pulling back all the way down. If it pulls back down, it's going to reduce the amount of profit which I'm getting already. And I have a 0.05 lots. If it's if I take just a part of it and better. So what you do is just go to that position and modify, or just, yes, you just go to modify. Once you select modify, you go to the position, and then it's a market execution. You go the steps, go to the position, select it, go to modify. On the type of modification you want to do, just select market execution. With the market execution, go to the volume. And what you want to do, we have a 0.05 reduces to 0.03, for example, 0.03, and then select close. So I need you to note that I have a 0.05 in this position down here, making $13. So I want to close part of it. More than half of this $13 profit should be closed. So once I click close, it's done. And you see the $13 has just turned to 5. If you go to my history already, I've taken how much? $8 is in already. $8 profit is in, but I had other losses which I had made today, so that's why you can see all this big one. But I wanted to focus specifically on this trade. $8 in. So what is remaining is 0.02, like you can see on the trade section. So you see, I've reduced my exposure. I have scaled out of the positions which I'm taken. So I have only 0.02. And even with this 0.02, I want to protect what I have already to around, let's say $4 up to that point. So I still move my trailing stop to close in $4 for me. If this price pulls back to the downside, I have my $4 plus the 8 which I have taken is $12 already. And if this price decides, or does it decide? I don't know. If this price keeps on pushing to the upside, maybe to this level here, of course, it's in the evening. You don't expect, yes, it might happen, but might not. But we have a chance of making another like 10, maybe 20, maybe 12, if the price keeps on pushing towards the close during the day, right? You might as well want to have a take profit on the upper side, so that if the price attains that level, then it just takes your profit. And that is how you want to do scaling in, scaling out in line with position sizing, right? Know the amount of risk you want in the market, the lot size that is going to, the lot size that is likely to expose you to that risk, or which is equivalent to that risk which you want to take in the market. And then you have two approaches. You might decide to go all in with that lot size, or decide to scale in with that lot size. Either way, it's your call. Okay. The disadvantage of scaling in is, for example, it's not the same if you enter 0.01 here and then you put in another 0.01 here. You've lost quite some ground here, right? Another 0.01. So the disadvantage is you're not going to have your profits running from us, from the best entry position, like from the low, from the first entry. I don't know the right ones to use, okay? There's some distance which you're losing. That is for scaling in. But you know what? You have an advantage just in case the price reversed from this level and kept on moving to the downside and hit your stop loss at the first, with the first entry. In that case, you will just decide to stay out, because like in this case here, it would mean that this point of interest which we had gotten here from the hourly levels, 2nd November levels, it means that now it's moving to the, maybe you're looking for other point of interest. So it will help you to get out early. That is the advantage. So everything which you apply has got its advantages and disadvantages, right? The advantage, we've talked about the disadvantage of scaling in. And that disadvantage becomes the advantage of entering with the whole position which you had estimated. After all, you know you're risking, but it's a calculated risk. For example, with the 15 pips which you are risking, it's within the drawdown of 10% for that trade for this 250 account. So that's okay. You're risking to get something. So then the thing is, you have the advantage. Once you accept that, you have the advantage of having your trade run. You an entry with a lot size, the big lot size from that as low as this, and then you're going to scale out, right? So you can decide to go two approaches. Estimate your lot size, then scale in. But that one is better with a trending market, which is going to give you pullbacks, or maybe you might want to go to a lower time frame where you can see a market structure like this, like in 1 minute, which is very low for most of us to use. You can see all this price pulling up and down, giving you all these lows for you to enter. So for the guys who use order blocks and all that, you can see you might have had scaling in opportunities, but again, at very low time frames, not very favorable for all of us, right? We have all these levels to use. There is that one. Of course, from down here, we have this one, the price touched here, pushed to the upside. Right? The next one. Okay, so started from this one. Price touched here, went all the way up. All the way up. And after this one, then the price touched where again? So you can decide to go to lower time frames where you can find these areas of interest, especially these order blocks, but it becomes very difficult to mark these ones, especially if you're not really used to these scenarios or this approach. You can see how the price touches those level, pushes the upside. That's where you're looking for re-entries with those lower lot sizes, right? This one has not kind of moved down to this level, okay? And that is where we are likely to get, I don't know, to go out if this trade decides to push back all the way down here. Of course, there are those approaches you use, or it becomes again to this level, right? So with scaling in, it's very good on a trending market. If you're on a very high time frame, you might not have found those levels. If you go to like 15 minutes, that one doesn't come out clearly. But if you go to around 1 minute, for example, you have those levels quite clear to follow and have your re-entries, right? So that's that for today. Unless if you have any questions on the chart, might look for 1, 2, 3 questions before we close this session. Risk management is essential for your trading. So you need to have different approaches of managing the risk and find the one which is better for you. I don't think I am getting any question. I don't see any question. Maybe in a minute or so. As I'm waiting for the questions, let me stress the importance of risk management. Risk management is very essential for consistency. Whichever trading approach you have, however confident you are with the trading approach, always use a stop loss. They will save you. Sometimes the trades which you have got very high confidence with are the ones that fail you. If you're a student of these markets, you will know. The trades you're very confident with, they just sometimes fail you. So you need to have a stop loss. You have very clear points of interest, but they are swept. And right after sweeping your trades, then it moves in the desired direction. And an example is what happened, I think last week, with the release of the news, it was just a sweep and then the price pushed all the way high. And even today, are those types of events where you looking at your entries for the people who look for entries on lower time frames. You have those, for example, someone who had entered a trade at this point of interest at this level here, because the movement here, the movement that we see here is indicated an entry around this area. So if you don't have a stop loss on this price, deciding to keep pushing to the upside, then what did you have? What would you have? Or for example, an entry at this point and you didn't have any risk management approach. You didn't scale out, you didn't have a stop loss, you didn't trail, then this one means a blown account, for example. So risk management is essential, irrespective of the strategy which you have, right? Risk management ensures that whatever you're getting, you collect it. Risk management ensures that you're protecting what you have, because in these markets, there are two things you want to be careful about, or two things that you're looking up for. Once you deposit your money into your account, you want to grow it, right? And make sure that you don't lose it, right? One way of making sure that you do not lose it is by scaling in, scaling out of the market, estimating the amount of lot size that you want to trade with. So, ladies and gentlemen, traders, see you next time.